Hi everyone, welcome to another market update with Lewisburg Investments. I have Mathieu Roy with me, VP of Equities. So Matt, how's it going today?
Great, Marcel. You?
Fantastic. So Matt, clients have a lot of questions about what's been happening in the markets. Could you dive into a little bit of what we see happening and how that's impacting our investment mandates?
For sure. Well, it goes without saying, it's been a difficult first half for most investors, really. And it's rare that you see equity markets and bond markets fall at the same time.
Yeah.
There's really been not a lot of places to hide. So it's a difficult environment. The sentiment is really a lot lower than it was.
Yeah.
Thankfully, in a way, a lot of our strategies have been performing well in relation to market averages.
Right.
We do have a disciplined approach in regards to investing, and that's helped us offer some relative value for investors. Certainly, performance is down across the board, but if you can preserve more value in times like this, it really helps out the long-term performance for our clients.
Right.
And how you go about doing that is stay disciplined in investing in quality businesses that generate value over the long term.
Okay.
This is something that we've been consistent with over time, and also not chasing speculative trends.
Yeah.
And it's difficult when everybody gets excited about a theme, but for us, they're all businesses, so the valuation has to make sense.
Yeah.
And we spend a lot of time on that. And a key to adding value for us in a lot of our mandates, but for example, our core Canadian mandate has been really not being in those businesses, which have fallen more when sentiment goes away and markets get more concerned about profitability.
Yeah.
The other part that has helped us is favoring very strong, durable businesses. For example, this quarter, investing in some of our strong consumer businesses, like Dollarama in particular, but the grocers like Empire, Weston, and also Saputo and Couche-Tard, very strong businesses. Doesn't matter what type of economic environment we're going in.
Right.
These will be strong businesses that create value over time.
Okay.
Now, going forward, I'd say I'm more optimistic today than I was 3-4 months ago.
Okay.
We are still facing some significant challenges from a variety of points of view, but there's inflation in the system, everybody knows that, and the Feds or central banks across the world are fighting it strongly, which will more than likely create a slowdown. We don't know if it's going to be a recession, but it's going to impair or reduce revenues for businesses.
Yeah.
And we already know that they have cost challenges. The offset for Canadian equities is we also have a lot of resource-based businesses that produce resources, but also that service this sector.
Right.
And you're seeing a lot of tailwinds in that sector of that. So this is a natural offset for a lot of our Canadian businesses. And given the correction that we've seen in equity markets, a lot of those challenges in terms of earnings growth, a lot of it is getting priced in.
Okay.
And we know that equity markets are forward-looking. We feel that as soon as you start to see some progress on reducing the inflation rate, equity markets won't wait for the Fed to stop hiking interest rates or start easing to get a little more comforted and excited about the future.
Right.
So feeling a lot better. We're not necessarily out of the woods, but you're also seeing opportunities in this area.
Exactly.
For example, a lot of the businesses that we avoided because they were too richly valued and has helped us create relative value in this environment are starting to be appealing.
Sure.
And so what's interesting, if you look at our large cap Canadian equity portfolio today versus 6 months ago, you now see businesses like Nuvei, Lightspeed, and Shopify, which were not candidates for us before. We knew them, we understood their attractive growth prospects and the strength of their businesses, but the market was way too enthusiastic in terms of what
That's right.
it was ready to pay for them.
Mm-hmm.
A lot of them are down 75, 80%, and now look pretty attractive.
And the business model hasn't changed, right?
Not at all.
Yeah.
So excited about this environment.
Sure.
Certainly a difficult period for investors, but this point forward, we feel that it's a pretty good environment for equities.
Okay. Well, I think that covers a lot, from what's going on in general to how we've been managing that. So thank you very much for your time. Hope that was informative, and we'll catch you guys next time.
Thank you, Mathieu.
Cheers.